All right, so in this video, I'm going to talk about the weighted average cost of capital. So basically, for the weighted average cost of capital, what we do is we take the cost of debt, the cost of preferred, the cost of common, and then we weight it by the proportions of the firm's capital that are coming from each of those places to get to the overall rate of return or the weighted average cost of capital that the firm needs to earn to keep all of the investors happy. So basically for our formula, what we have here is our weighted average cost of capital is the WD, or the weight of debt, or proportion of debt, times RD. This is my cost of debt, or the yield to maturity on their longer term debt, times 1 minus T. T is the tax rate. And keep in mind that RD times 1 minus T, that chunk together is called the after-tax cost of debt. Then I take WP, this is the proportion of the firm's capital that came from preferred stock, times the required rate of return on preferred stock, which I discussed in a prior video, plus the weight of common. So this is the proportion of the firm's capital that came from common equity, times the required rate of return on the common equity. And I talked about that in a prior video as well. And then we work it all out and we get our weighted average cost of capital. So the RD, RP, and RS I talked about in prior videos. So let's talk about the W's. All right. So the WD is the weight of debt, or the proportion of the firm's capital coming from debt. So basically what we're going to do is we're going to calculate that using the book value of the debt divided by the total amount of capital. So for the total amount of capital, we're going to take the book value of the debt plus the market value of the preferred plus the market value of the common. So book value of debt plus market value of preferred plus market value of common gives us the total value here of capital. Now, if you're thinking, well, that seems like a little bit of a mismatch here. I'm using book value of debt, but I'm using market values for preferred, market value for common, and what is market value, right? I'll talk about market value in a moment here. But it is a little bit of an interesting point. So let's kind of talk about that. So for the book value of the debt, we're looking at the value of the firm's debt, generally their long-term debt on the books. So think the balance sheet, right? So we're looking at the balance sheet. So I'm looking at balance sheet figures. Generally, the assumption here is that the market value of the debt is probably relatively similar to the book value of the debt. The debt can sell at premiums and discounts in the market, but generally, on average, if a firm had a bunch of bonds outstanding, some of them are premiums, some of them are discounts, then on average, that book value of debt on the balance sheet is probably a halfway decent approximation of the market value of the debt. Also, keep in mind that the firm has lots of different kinds of debt, so it actually would be kind of painful to try to, calculate out the full market value of all the debt that's out there. But basically, that's kind of the idea here, that there's a rationale for why I'm using the book value of the debt there. Now, for the weight of preferred, I take the market value of the preferred divided by book value of debt plus market value of preferred plus market value of common. So notice across all three of these calculations, I'm using that same denominator. I'm just switching what I have on the numerator. So for the weight of common, I use the market value of common divided by book value of debt plus market value of preferred plus market value of common. So if I do all these calculations, I calculate my weights. I'm going to have the weight or proportion of the capital that came from debt, the weight or proportion of the capital that came from preferred, the weight or proportion that came from common. And ultimately, what that translates to, then I plug that in along with the RS, RP, RD, and T that I discussed in prior videos, and that would get me my weighted average cost of capital. Now, a few little notes. Because all of my capital came from debt, preferred, or common, right? So I know that all my capital came from one of those three places. So if it all came from one of those three places, the weights must add to 1. In other words, 100% of the firm's money came from somewhere, right? So the weights have to add to 1. Now, if you're looking at that calculation, you're thinking, well, how do I find the market value of common equity? Well, to find market value, you take the price per share times the number of shares outstanding, and that's going to give you the market value. Or if I'm doing that for the common stock, basically what we're getting is the market cap. So I'm finding the total value of the firm's stock in the marketplace. Now, it's important to note, if I'm getting that book value from the balance sheet, the book value of the debt from the balance sheet, and I'm calculating market value by price times shares, you got to be very careful when you're doing this that you don't goof things up and wind up with the wrong scale. So for instance, on the balance sheet, the firm may have numbers reflected in millions. So for instance, if they have 200 on the balance sheet, what that really is 200 million, right? Whereas if you use the price per share times the total number of shares, you just have the total amount. And so it's not scaled in millions, and whereas the balance sheet in my example was. And so if you're doing that calculation and you start mixing and matching scales, you'll get very wrong numbers. So the way to address that is make sure that either you turn everything into just the total number of dollars. In other words, if it's 200 on the balance sheet and the balance sheet is in millions, write it out as 200 million, right? Put all the zeros on there to get 200 million. And then if you're doing price times shares and you have the total number of shares and you have the price per share, you got a number that's just dollars. You have a book value for debt that's now in dollars. You can run your calculation and you're fine. Or make sure that you put your market value into millions if the data you're getting off the balance sheet for the debt is in millions, right? So basically, just make sure your scale is consistent throughout, or you're going to get goofy numbers if you're doing this for a real company. And something that sort of illuminates when you've got things kind of a little sideways, most of the time, in my experience, if you kind of goof up the scale, what'll happen is your weights of debt and equity are going to get real skewed. And what's going to happen is generally you're going to wind up with like, it looks like the firm's got, 99% debt or, 98% debt or something, or it goes the other direction. It looks like they've got, like 97% equity. And you're looking at it, you're like, but it kind of looks like they actually do have a lot of debt. Like, well, how is that? It's possible if the market value is so much higher than the book value, that you get percentages like that. But it's also possible that you goofed up the scale, right? So just kind of pay attention to the scale. And if you get a really extreme capital structure where it's almost entirely debt, 99% debt or 99% equity, just basically just double check your scale and make sure that you've done your calculations kind of correctly. Now, a little note here, if you think about this then, what's happening to the capital structure if the price of a firm's common stock drops? Well, if the price drops, price times shares drops, market value drops, right? So if market value drops, so I look back at the formulas here, the market value of common is going to shrink. Now it's also going to affect the denominator as well, but that's not the only factor in the denominator. So the numerator is going to shrink by proportionally a larger amount than the denominator, which basically means my weight of common collapses, right? So if I have a situation in which I'm looking at my weights of the different types of capital, if I have a big drop in the price of a firm's common stock, basically my weight of capital shrinks. And basically what that means then is basically that all of a sudden it's going to look like, in terms of my weighted average cost of capital, that I'm skewed towards debt. And it's going to look like on a proportionate basis, I have way more debt than I used to. So I could have and that could create a problem because now an investor looking at the company is like, wow, I mean, they've got like 95% debt. Well, if my stock price collapses badly enough, that can actually happen because basically it's dropped the weight of common equity. So now, think of it this way. If I have some bad news, my stock price drops, I lose a bunch of sales, and now all of a sudden my weight of equity has just collapsed to next to nothing. My weight of debt is now 95%. Well, who wants to buy stock on a company that has bad prospects, sales are bad, stock prices collapsed, and now it looks like I got 95% debt? I don't know that I want to buy stock in a company that's got a really bad situation going on, and now it looks like they got 95% debt. They might be about to go bankrupt. If they go bankrupt, me as a shareholder, I'm going to walk away with nothing from this because they got so much debt. So that could create a very bad situation for a company. So a company actually is going to care about kind of what's going on with their stock price because it does affect their cost of capital and their capital structure. Also, if the cost of common equity, if I think about the cost of common equity, if that stock price drops, let's kind of rewind a little bit. So if I am calculating the cost of retained earnings, and I'll just use the Gordon's model here from kind of prior video I did. If this P0, the price drops, RS goes up. So basically, if my stock price tanks, what happens is, one, it looks like I've got a smaller proportion of equity, basically because my weight of common equity is going to shrink. And my cost of common equity is going up, which basically means my capital structure is a mess. My cost of capital is rising. And this is going to be a real problem for me. And so this is not going to look good. So from that standpoint, that'd be kind of a bad situation there, right? So all that to basically say, market circumstances will actually matter, and it will affect the firm's cost of capital and their capital structure if there are big swings in the firm's stock price. Ultimately, what we're kind of targeting here is, based on this graph, which I've shown in a prior video, what I'm trying to come up with is the weights of equity and debt that lead and preferred that lead to me being at that low point, wherever that low point is. So the low point may not be exactly in between equity and debt. For some industries, the low point might be over here somewhere. So the graph might look like it's got a little dip down and then goes back up. Low point might be over here. Or maybe for some other companies and industries, the low point might rise over here and then go back up. So, wherever the low point is, that's what we're going to look for. And it may be at different spots for different companies and different industries, but that's basically what we would be looking for. All right. Hopefully that video about how to calculate the weighted average cost of capital and some of the implications is helpful. Thank you so much for watching and have a great day.